there is a typical or predictable arc that investors go through. And when they get to the end of that arc, they're called, or I kind of identify them as outlier investors. And this arc usually starts with going to a big box advisor and then finding out in whatever amount of time they find out in, which could be anywhere from immediately, this person can't help me, to years. They then try out a independent advisor. And they go through that learning process. Either immediately they learn that that independent advisor is just like the big box advisor, or it takes them a couple years. But then they notice those big box and independent advisors are really both just conventional advisors. And when the market goes up, their money goes up, minus commissions and fees. So they get the full gain of the market going up. And then when the market goes down, they get the full loss of the market falling, minus commission and fees. So typically after that, a certain type of investor will go, well, I don't need to pay you to get the full range of the market minus commission and fees. I can do that on my own. I just buy SPY. And so that investor moves towards the do-it-yourself arena of proper, appropriate, learning the right way to invest. And one of the places they go is they read books, but books don't really help them because it's just content and it's information. And though that investor may not recognize or acknowledge this, but content, it's okay. Mostly it's free, but it's really the implementation of it and doing it with others and being held accountable that's the difference. So then they go to the weekend workshop where there are other people, and it's very logical, and it's actually fun, and it's exciting. But then that do-it-yourself investor, they keep getting hit with this thing called Monday, and Monday keeps hitting them. So then they think, well, maybe it's not about knowing what to do. Maybe it's about knowing what specific stock to buy. Maybe that's it. Maybe if I just knew the right ticker symbol or share to buy, that's the key. And so they enter the world of newsletters, either pick of the week newsletters or pick of the month newsletters. And they're enjoyable. They're very well written. Each month there's a new story about an amazing breakthrough in technology or cancer killing vaccine. And so these stories kind of elevate their status with their friends and their colleagues at work, and they can sound really smart. But it doesn't actually help them grow their money. And so they become what I kind of call an outlier investor, right? They've learned kind of everything that doesn't work, but they haven't really learned what really works, yet they know there is something that really works. And that's why I started Fearless Wealth, to have a home or provide a home for outlier investors, which I kind of identify as myself as being an outlier investor. I want to know how it works, and I want to do it the right way. And I don't want to learn anymore what doesn't work ways. And in these weekend podcasts to you, these weekend conversations, I want to bring little pieces of nuggets of what the price charts are showing me. So with that, this weekend's theme is forecasting with price. And this will tell you a little bit about why I also like price charts so much and why I study price. Hey everybody, this is RC Peck, and this is my weekend podcast. Good to have you here. I got my kids in the other room. Did not have to bribe them, but I said I will need 10 minutes of quietness to record this for my world, people in my world, my outlier investors in my world. So we may get a knock on the door. We'll see. I have some pretty cool charts that I want to show you that help me kind of forecast. And a forecast, just so you're clear, is a statement of probability about the future, right? It's not a prediction. It's a statement of probability. And the best way I can learn about probability is looking at price charts. So this first price chart I'm looking at, this is a price chart of U.S. long-term bonds. It's a ticker symbol TLT. And This is a 5-year chart. Also, it can be called a weekly chart, meaning each dot on here is the closing price for a week going back 5 years. And I put in a blue horizontal line to show you back in 2012, the price could not get above this 120 mark. And it bounced off it twice and then moved back down to about 98. And then it moved right up and through 120, all the way up to 137. And now it's sitting back down on that 120. So from a probability point of view, if that 120 number holds on TLT and the price of TLT goes higher, when the price goes higher on this chart, or when the line goes higher in this chart, that means yields go lower. So if in fact the old ceiling has become a floor or resistance or support, then that means the yields going up have kind of reversed themselves. Now, we don't know yet because there's this other kind of little battle going on right here around 123. So basically, TLT's bounce between 120 and 123, trying to figure out which direction to go. And it will figure it out. And so as of right now, we may have hit a turning point where price is going to go back up, which means yields are going to go back down. Now, we don't know. And I believe it was 2 or maybe 3 podcasts ago, I showed you a price chart of TLT and said it has to break above this again for yields to go down. And if it can't, that means yields are going higher. So as kind of looking at the price chart of long-term U.S. bonds, we are still in a decision-making point of whether yields are going to go higher or lower, meaning continue to go higher as they have been. The price has been going higher, the yield's been going lower, and is that going to continue, or is there a reversal happening? The second price chart, look at this one. This is actually the yield, and I know this can be confusing for a lot of people, but the actual yield of the 10-year Treasury. So this is not a chart of price, this is a chart of yield. So the 10-year Treasury is currently yielding about 2.1%. 2.1%. And if I zoomed way out on this, which I'm not, this is a 5-year chart looking at 5 years of data, generally speaking, the yield is falling. And I put in those 2 horizontal lines to show you where often the yield will bounce off. So back in 2010, it was falling down to 2.4% yield and then bounced off that and moved higher and then moved right through that and came back up to this 2.3 mark, bounced off it, came back down, 2.3, fell down, went up through it. So the 10-year yield has a relationship with this kind of 2.25 to 2.4% yield. And as you can see from the beginning of 2014, yields have been falling. Now, we had yields really drop off and then move back up pretty much for 2015. But if you look here from 2014 till today, yields have been falling. Now, what has to happen for yields to go higher is it has to break above kind of this 2.25, as you see kind of this double top right here. Has to break above that. Has to break through this kind of Maginot line here of back and forth. And if it does break through above these two, that's very strong. Again, this is yield. And break through kind of the Maginot line of the 10-year yield, right? But it's not right now. It's falling right now, and these highs are getting lower. You can see these highs all getting lower, and you can see the lows, generally speaking, getting lower. So that's saying possibly yields are falling or will continue to fall. But like anything, there's nothing that is 100% clear, because look at this price chart here. This is a price chart of regional banking stocks. Now, what helps regional banking stocks go higher is higher interest rates, because the regional banks can increase their profit and their margin when interest rates are higher. And so one can say, well, I'm looking at the regional banking sector and it went sideways for entire of 2014 and part of 2015, and it's finally broken out into the upside, as you can see way up here in the right corner. So one could say, well, they're breaking out because yields are going higher. That may be. It could also maybe be there's just a nice consolidation, a very scary consolidation of about a 10% correction 5 or 6 times. But certainly one could say, well, yields may be going higher because regional banking stocks are heading higher, and broker-dealer stocks are going higher. Broker-dealers like TD Ameritrade and Schwab, they can increase their profits significantly when interest rates are going up. Now, they're not going up yet, but one could say, well, look, regional banking stocks are going up and broker-dealer stocks are going up. And you can see the broker-dealers couldn't kind of get above this 39, but tried to get above it, failed, broke above it, went right back to it, and moved higher. So you've got broker-dealers moving higher, and you got regional bank stocks moving higher. Now stick with me here. You have REITs, which are real estate investment trusts. People typically buy REITs. Now this ticker symbol is IYR. There's a lot of REITs in here. And the price of REITs is falling. Now typically when the price of REITs fall, it's because people are scared that rates are going to go higher. Now if you look at this price chart, you can say, hey RC, this is going from lower left to upper right over the last 5 years. This may be just a correction. And the answer is, yeah, you're right. It may just be a correction. But this is the first time in 5 years that the Federal Reserve Chairman, Janet Yellen in this case, is saying, hey, we're thinking about raising rates now. We stopped our money printing like we told you we were going to do. And then we talked about how we're going to possibly increase rates. And in fact, we're taking away language now, so you can't try to figure out my language on what we're going to do. So we're early on this. But I'm watching it. I'm watching the yields. I'm watching the price of sensitive sectors to, when yields go up or down. But right now, REITs are saying possibly that, in fact, rates will go up. And then lastly, I have utilities. Utilities historically have been sensitive to rates. But again, as you look at this price chart going back 5 years, it's going from lower left to upper right. It's been going higher. This could be just another situation where XLU is just correcting. That's all. It's just making a correction. Right? Couldn't really get above that 40 mark. Finally did it. Sat right back down on that 40 and just been going sideways for about 3 months. So what we were going to want to see is a break above this 45 or a break below the 40 or 44 or 40 is going to really give us an idea of where interest rates may go. Again, we're just kind of forecasting here, looking at price charts. Forecasting is a constant thing. You constantly look, or I constantly look at the price charts just to see what they're saying. And looking at price charts is perhaps the most effective way of looking into the future, of kind of seeing the probability of what will happen. And that's what I'm doing right now with these price charts, and that's what I'm showing with you. Right? So we have utilities saying, hey, rates may be going up. We have REITs saying, hey, rates may be going up. We have regional banking, and we have broker-dealers saying, hey, rates might be going up. So we have 4 sectors of the stock market saying rates may be going up. But then we look at the actual rates themselves, and it's more of a, well, let's see. Long-term rates, that was the first price chart I showed you, TLT. Those might be going down. But the 10-year, that may be stabilizing. Remember, because the government can't control the 30-year or the 10-year. They can control very short-term rates. So we may see rates going up because we're looking at 4 sectors here that say, hey, maybe rates are going up. And it depends what rates you're talking about. That's the other thing I want you to get. What rate are you talking about? Long-term, 30-year, 10-year? Mortgage rates? Mortgage rates are connected mostly to the 10-year Treasury. So it depends on what rate you're looking at. But certainly, broker-dealers are going up, regional banking stocks are going up. Which leads me to my takeaway for you. So increasing yields, or if yields do go up, they're going to help some people and they're going to hurt some people, or they're going to help some sectors and hurt some sectors. Same thing if yields go down. So if yields do go up, it's going to help broker-dealers like Schwab and TD Ameritrade. And it's going to help regional banks like Fifth Third. Is it Fifth Third? I always get that. I mean, even though it's one of our obvious trend index, I always get the name. It screws up in my brain how to say that. But it's going to help regional banks. And if yields do go up, it's going to hurt utilities and REITs because those are very sensitive. And so that's what we're kind of seeing right now, and I'll watch this. And the biggest takeaway, too, again, is it depends what yields you're looking at. It's very likely that the 30-year yield will come down. That's what it looks like right now. The 10-year is deciding, but right now it's kind of heading down a little bit right now. So we could actually see short-term rates go up, right, like the federal funds rate or the discount rate, and see long-term rates stay stable. And so it'll be interesting to see. Broker-dealers and regional banks are saying, hey, rates are going up. Utilities and REITs, they're kind of undecided right now. And so I'll continue to look at that and report back to you what to do with this. And really, what I most want for you, and the reason I started a membership site, is so it's not just more information. It's not just, okay, that's another cool story about China or interest rates or currencies or gold or silver or whatever it is, but what do I actually do, RC? Like, what do I do with this information? And I put a membership site together, literally including a free key to my library of all the tools I've ever built over my entire adult life, building tools for people to show them the right way. Those people, those outlier investors. And so that's what that membership site's for. Hey guys, I'm so glad you're here this weekend. This is just another step in helping you secure your future and your portfolio. Until next time, this is RC Peck.